there, everyone. Dave Keller here, Chief Market Strategist at Stockcharts.com. And here is the final bar for Wednesday, June 12th, 2024. We're coming to you from a beautifully sunny, little bit cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using technical analysis tools today, and obviously a news-packed day with the CPI for May coming out before the open. The Fed meeting, of course, this afternoon. A lot of focus, as always, on Powell's comments in the press conference afterwards. Generally speaking, a lot of the themes that were in play leading into today's session, continuing in play after today's session. With that in mind, let's get to our market recap. Look how the market traded through that Fed announcement and soon after. The S&P 500 finished the day just above 5420, so that is a new closing high. As always, first time closing above 5400 in history. That's the S&P up 0.9%. The NASDAQ composite leading the way, almost doubling those upside percentages, up about 1.5%. Closing above 17,600. The Dow actually finished narrowly in the red. So we have that familiar pattern of the growthy leadership working very nicely. The Dow representing a lot of the other sectors and other themes and other types of stocks not doing particularly well. Gapped open. The Dow actually opened above 39,000, but by the end of the day, we finished around 38,700. Mid caps and small caps both in the green. The S&P the S&P small cap 600 that is was up the most, up 1.7%, closing above 1,300. Now the VIX remaining quite low, and you can see that the VIX was actually down still in the low teens, finished today around 12. So the volatility as defined by the VIX remains very muted. We've talked about that in recent shows about how there's this bit of a disconnect between volatility as defined by the VIX, which is looking at the S&P index options market, and the volatility of individual stocks. There are stocks moving quite a bit today, right? And if you look on our dashboard in this widget called Market Movers, you can look at stocks in a particular index. You can see what was up. You can see what was down. There are a lot of stocks having big moves to the upside and big moves to the downside. I think that is the reality of the markets here in June of 2024, where the very low VIX, I think, gives a false sense of security for equity investors who in a lot of ways are dealing with plenty of volatility here. So keep that in mind before you think of this as a low volatility environment. Depending on what you're looking at, the volatility is actually quite present. Interest rates overall moving lower. Of course, the CPI number before the open today, really was pretty much in line. It was sort of a little lighter than expected, but overall still well above the Fed's bogey of 2%, came in above 3% on an annualized basis. So that's still above that scenario that the Fed is looking for, which is a 2% annual gain for inflation. However, the Fed this afternoon talked about, pacing themselves, about being in no hurry to cut rates. First rate cut now being priced in at the November meeting, and the market is currently pricing in 2 rate cuts for 2024. It looks like once in November and once in December. But overall, the Powell's comments still reinforcing data dependence, and they'll wait to see how the data comes in between now and then. There's a lot of game left, as they would say. For today, rates moving lower as bond prices move higher. The TLT was up about 0.8% today. Bond yields coming down. You can see the 10-year point just below 4.3%, about the same for the 5-year yield, and the long bond yield a little bit higher. The dollar index down about 0.5%. So we continue to see stocks strengthening, bonds strengthening, dollar weakening. And that is a very good environment for growth stocks and for risk assets. Commodities overall kind of mixed here, to be honest with you. Gold and silver and copper prices all positive. Crude oil, as using the USO here, was up about 0.2%. Some of the other energy-related commodities were down, and the energy sector was actually the worst performing sector today. Cryptocurrencies overall quite noisy. Bitcoin did briefly touch 70,000. Once again, that level comes into play, and I feel like a broken record, but I would just remind you, especially if you're trading these things shorter term, which I would not encourage a lot of people to do. It is a very volatile, very risky premise to try to day trade something like cryptocurrencies. But if you are, note how many times we touch 70,000 almost to the tick and then rotate, right? We rotate above and below those levels very often. Big round numbers tend to matter in a big way for Bitcoin, and we've seen that once again today. Currently, just above 68,150, we'll call it. Ether prices around 35.50. Both of those and the rest of the top 10 coins that we track on our platform, all in the green right now. Looking at the 11 S&P sectors, we continue to see technology and then everything else. Now, granted, about half the S&P sectors did finish in the green today, so not a bad day from a sector perspective, but it's the biggest names really doing the lion's share of the gains here. Technology, the XLK is your top performing sector, up 2.2%. You can see the consumer discretionary sector, XLY, was up 1%. About the same for the industrial sector, which was third from the top. At the bottom of the list, we have energy and consumer staples, both down just slightly over 1%. The utilities sector, XLU, down about two-thirds of a percent. Looking at the Magnificent Seven and Friends, these are some leading mega cap growth names. You can see Tesla actually managing to finish at the top of the leaderboard today out of this list of mega cap growth stocks. Tesla was up almost 4% today. NVIDIA up 3.6%, continuing to dominate the semiconductor AI trade. Apple, of course, having a great day on Monday. Really, Monday was about the conference, the developer conference, and all their announcements. Tuesday and now Wednesday session, Apple really getting rewarded for overall embracing AI, up almost 3% today. On the downside, only one of these leading growth names was down. Amazon finished slightly lower, about 0.2%, but overall this space of leading growth names doing just fine. Looking at the daily chart of the S&P 500, let's look there next. You can see, of course, the primary uptrend continues. The S&P keeps making higher highs and higher lows. And today we gapped higher again, trading above 5,400 for the first time. It's worth noting that we actually, by the end of the day, finishing more toward the lower end of trading. And so this actually is looking a bit like what we would call a shooting star candle. If you know your candle patterns, a shooting star candle is something you find in an uptrend, and in a primary uptrend, you don't have to have a gap, but you do have to have this general shape, which is where the open and close are near the lower end of the range. There's little to no lower shadow, and there's a long upper shadow. And think about what that means, right? We open, we trade higher, we close more toward the lows. Usually suggests the next 1 to 3 bars is going to be down. Interesting that that's the setup that we see on the chart of the S&P 500 after Wednesday session after the Fed. A couple other comments quickly on the chart of the S&P 500. Of course, we remain above key trend following devices. We're above upward sloping moving averages. That's bullish. We're making new highs and higher lows. That's bullish. We're above trend line support. If you look at the major lows over the last 6 to 7 months, we remain above there, and we've tested that trend line a number of times, which means for me, as long as the S&P remains above 5,300, we're not even breaking the first one of those lines in the sand. I think 5,200 is sort of that main level for me. That is the 50-day moving average is right about there. 5,200 is also the swing low from late May. So as long as we hold that on any pullback, which means you've got 220 points of room on the S&P. That's about, 5% to get down there. That's a pretty decent range that we could pull back and still be within a clearly defined uptrend of higher highs and higher lows. That's the space that this market has, given the strength that we've seen today. Also want to note, we've talked about a potential bearish momentum divergence with the S&P making higher highs, but the momentum actually sloping downward. We have seen that on plenty of stocks. As a matter of fact, some of the stocks we'll look at in the financial sector later in the market recap have that pattern. But we're not seeing it anymore in the S&P. And that was one of the things we mentioned here recently is the way that you negate a bearish divergence is you see stronger price action on stronger momentum, right? A divergence is stronger prices on weaker momentum. We're actually no longer seeing that. The RSI is now overbought back above the 70 level. So no bearish divergence for the S&P. This tells you that the uptrend is relatively strong when you think about the momentum figures. Now, you're not seeing strength in the market when you think about breadth data. And as a reminder, right, we're updating some of these data points after the close here. So not all of these are updated for today's. You can see that some of these are still from yesterday's close, but you can see that the advanced decline data on the New York Stock Exchange did bounce slightly higher, but the trend in the 80 lines has been down. So S&P clearly going up over the last 3 to 4 weeks. The advanced decline lines clearly sloping lower. The McClellan oscillator most likely remains below zero. I haven't checked it for today's close yet, but up until today, still below zero. So we've seen stronger market action on weaker breadth, and that is often a sign of internal weakness because there's a lack of breadth support. What you would need to see is more and more stocks participating in the uptrend, and maybe we're seeing some of that with today more of a broader advance, more stocks closing higher than lower today, but overall the trend remains fairly weak. I do want to point out, what else do I want to point out? Oh, volatility, right? We look at the VIX. Here we have the VIX in the low teens, right around 12. And again, I would caution you to draw too many conclusions about the volatility environment, because the volatility as defined by the S&P index options market, which is what the VIX is doing, is very low, right? The VIX in the low teens is a low volatility environment, tells you that the market conditions are low volatility, high confidence in an uptrend. That's great. The warning sign for me, which we last saw in early April, is when the VIX pops above 15. That tells you we may be in a condition where we start to see elevated volatility. That means elevated uncertainty. That means elevated fear, and those things tend to be coincide with higher with weaker stock prices, right? With prices moving lower. So right now volatility is low, but the volatility as measured by the movement of individual stocks remains quite high. And I would say when you look at the market movers and you see stocks moving up and down, like Oracle and Apple gapping higher, financials gapping lower, there's plenty of movement underneath the hood. So as an equity investor, as a stock picker, you may actually be experiencing way more volatility than the VIX may be suggesting. One more macro chart here. This is offense versus defense. On the top, we're looking at the XLY versus the XLP. When this ratio is going higher, which it has been doing so far month to date in June, that tells you that things you want, or offense, is outperforming things you need, or defense. But the general trend in this ratio has been down. Now, this top ratio is dominated, particularly in the numerator, by Amazon, Home Depot, Tesla, which make up about 50% of the XLY. The equal weighted version is clearly trending higher over the last couple of weeks. And I would note that in early April, which is the last time we had sort of a major pullback, this ratio turned lower pretty aggressively, which told you that investors are rotating more to the general defense as represented by the consumer staples sector. We are not seeing that from late May to now early June. We're actually seeing this equal weighted ratio push higher, suggesting that it is risk on offense over defense. As long as that ratio keeps going higher, conditions seem to be okay. Let's look at some of the names sort of on the move today. Apple, of course, following through after Tuesday's move higher. That was Monday. We had the Worldwide Developers Conference. Tuesday, nice reaction. I feel like today continuing that move, clearly a follow-through move to the upside. Feels like Apple is a sleeping giant, which has now been awoken, making a clear case for how they will be integrating AI into all of these devices that we already own and we already have in our pockets. So when a company like Apple decides that they're going to start focusing on AI, which they clearly have been doing, but making it more of a clear priority for investors, which I think they very much did, you see the potential of a company like Apple with all of the resources they can bring to bear, with all the cash they have ready to allocate to something like AI. The market rewarding that with further upside. Today finishing up another 3% higher almost, closing above $210 a share. Oracle also with a decent move to the upside. They reported earnings after the close yesterday. Stock was trading higher in the after hours today, opened around 134, closed another 13% higher, closing above 140. Now, with both of those charts, with Apple and with Oracle, the daily charts show you the gaps. They show you the big move to the upside this week. I would say the weekly charts really tell the story. That's where you can see Oracle with a meaningful break above 125 really clears out of this basing pattern. Apple breaking higher, breaking above 200, clearly exiting that consolidation range, this sideways trend that it's been in for quite some time. So I think the weekly charts of these software and hardware names really show the magnitude of this breakout and what it might mean as a longer term thesis for something like Apple or Oracle. Also in the technology sector, I just want to highlight Skyworks. And this is one of those really interesting charts, by the way. I want to bring up a chart that I have with some of the Fibonacci retracements allocated. If you look at the chart of Skyworks for the last 2 years, you take the October 22 low, which is a major low. You take the February 23 high, which is a major high. 38.2% of the way down is right around $101 a share. 61.8% of the way down is right around $90 a share. Look at how often we tested that support level. We did break below it in October, where it came resistance. Then we finally broke back above there. This has become support again in May and June, right around $90. You can see this week we're sort of bouncing like a springboard off of that Fibonacci and price support. We're now above moving average resistance and now back above the 61.8% level. What I like about a chart like this is Fibonacci retracements give you sort of a framework, sort of an idea of risk versus reward, right? What's the upside or downside potential? Where might you expect support and resistance? What does it mean that we've broken above that Fibonacci level? And then think about the importance of holding that Fibonacci level around 101. If we get any choppiness here, if we can hold 101, that still means we have upside potential back to test some of those previous levels of resistance. It gives you a clear idea of where you might be able to set a stop based on that Fibonacci framework. Now, if everything I just said about Fibonacci retracements does not make sense, I would encourage you to join me for my next free webcast. It's coming up next Tuesday, June 18th at 1 p.m. Eastern, called Mastering Fibonacci Retracements, Unveiling the Golden Ratio. We will talk about how to look at charts like Skyworks solutions with a Fibonacci framework. We'll talk about what levels that I like to select for the highs and lows, what those percentages mean, and why they are important. You can sign up for that free event coming up next Tuesday, the 18th, by going to marketmisbehavior.com/Fibonacci, or just scan the QR code that you see on your screen. A couple other charts just to finish off here. I do want to show Progressive, which is one of the insurance names, obviously, in the financial sector. The financial sector, I've had a lot of questions on this recently, certainly showing some weakness. If you look what's happened this week, Progressive failed yet again to get above resistance around 215, now rotating lower, breaking below the 50-day moving average, now testing price support. I think we go below $200 a share, and this is becoming a very clear rotation from an accumulation phase in Q1 to a consolidation phase through much of Q2 to maybe the beginning of a distribution phase. And this comes after a bearish momentum divergence in April, May, with higher prices but weaker RSI, weaker momentum. And you're finding that in a lot of other financial stocks as well. Here's Citigroup with higher highs April into May, lower peaks in momentum, with the RSI much higher in April than it was at the new high around 65 here, with the RSI right around 65 as well. So higher prices, weaker momentum. This is now rotating lower below now a downward sloping 50-day moving average. So while rates overall coming off today, some names like Citigroup, like Progressive, and a lot of other financial stocks having a really tough week, and that's after really showing signs of topping in April and May. Folks, that's it for our show. Thanks so much for joining us every weekday after the close for the final bar. And for Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.